Trading is a dynamic fusion of science and art, where chart patterns, signals, and insights provide the scientific foundation for traders' studies. But beyond the science lies the art of risk management, which traders must master. Welcome to dooacademy. In this episode, we'll delve into the art of trading and effective risk management controls. Effective risk management begins with diversification. As the saying goes, don't put all your eggs in one basket, and this principle applies to investments too. To implement diversification, we must allocate funds across a wide range of investments using a diversified strategy. This involves spreading investments across different asset types to control risk and maintain financial stability. For higher returns, individuals can consider a combination of stocks and bonds, with a higher proportion of stocks in the portfolio. Stocks offer greater potential returns but higher volatility, while bonds provide stability. Conversely, for those nearing retirement with reduced income stability, adjusting the allocation is crucial to increase the proportion of bonds. As an investor, it is critical to assess your financial capacity, investment goals, and risk appetite. You should adapt your strategy based on market trends and personal needs to manage risks effectively. In the world of investment, two primary approaches stand out: passive trading and active trading. For beginners, starting with passive trading is advisable. Passive trading involves less frequent trading, relying on long-term holdings to generate profits, rather than profiting from short-term price fluctuations. The goal of passive investing is to build wealth gradually through a buy-and-hold strategy, where you hold a security for the long term. One popular example of passive trading is investing in exchange-traded funds, ETFs. By investing in ETFs, you buy a diversified basket of different stocks, spreading your investment across multiple companies with just one ETF. Investing in ETFs offers several advantages. Firstly, it simplifies the investment process compared to individual stock selection. It also provides diversified risk control, saving time and effort in researching individual companies' financials and prospects. Instead, you passively track the performance of the corresponding index. To ensure effective risk management, consider adhering to the strict 5-15 rule. The 5-15 rule focuses on two key aspects: individual trades and the overall trading portfolio. This rule determines the proportion of a single investment compared to the entire investment portfolio. For instance, if an investor has $10,000 in their account and can tolerate a 5% risk, each trade should carry a maximum risk of $500, while the entire investment portfolio should not exceed $1,500. Applying the 5-15 rule allows investors to manage risk effectively. They can open multiple trades, increasing the overall risk by a limited percentage while ensuring the total risk of holding positions does not exceed 15%. Once you have mastered the passive trading strategy and wish to pursue higher profits, you may consider exploring the world of active trading. Active trading involves a more hands-on approach and a much deeper analysis to decide on when to buy or sell securities based on short-term price movements. By carefully monitoring the investments, the main goal of this investment strategy is to take full advantage of short-term price fluctuations to maximize profits. Due to the higher frequency of trades compared to passive trading, active trading involves higher costs and risks. Active traders also need to invest more time and effort in research and tracking their investments. This involves developing strategies for better returns by analyzing the qualitative and quantitative factors of individual companies and industry data. The 10-30th rule can be adopted to help active traders limit the risk taken in each trade and overall portfolio. For example, if a trader has $10,000 in their account, the risk control per trade is 10% or $1,000, while the total risk for all positions must not exceed 30%. Applying this rule allows active traders to take calculated risks while managing their investments more effectively. Effective risk management is a crucial skill to become a successful trader or investor, no matter if you're a beginner or experienced player in the market. It helps reduce risk and equips you better in dealing with market uncertainties in your trading and investing journey. So, have you been taking the necessary steps to mitigate your risks? Share your thoughts in the comments below. Be sure to like, share, and follow dooacademy for more actionable investment insights.